When stock indices climb, it often signals that investors are feeling optimistic about economic growth. That optimism tends to reduce the demand for safe haven assets, and the US dollar is the primary safe haven in global finance. So, you'll frequently see a scenario where rising equity prices put downward pressure on the dollar. This isn't a hard rule, but it's a strong tendency driven by risk appetite shifting away from currency safety and toward corporate earnings. Now, flip that relationship around. A falling dollar makes US exports cheaper and more competitive on the global stage. It also means that foreign buyers need less of their own currency to purchase dollar-denominated goods. This boost to trade and multinational profits often feeds back into higher stock prices. The two markets are locked in a feedback loop, each reacting to and reinforcing the moves of the other. Oil introduces a whole different set of cross-market links. Since oil is priced in dollars globally, when the dollar weakens, it takes more dollars to buy the same barrel of crude. That pushes oil prices up. But there's another layer here for currencies like the Canadian dollar. Canada is a major oil exporter, so when crude prices rise, Canadian energy revenues balloon. This brings more foreign capital into Canada, directly boosting demand for the CAD.so. The chain reaction works like this: stocks up, dollar down, oil up, and then CAD up. But it doesn't stop there. A higher oil price also increases production costs for many industries, which can squeeze profit margins in sectors like airlines and manufacturing. This can eventually weigh on stock indices, creating a subtle balancing act where oil gains are not always good news for equity bulls. Gold is another critical node in this web of connections. Gold is the ultimate anti-dollar asset. When the dollar falls, gold becomes cheaper for holders of other currencies, which drives up demand and its price. A rising stock market with a falling dollar often coincides with gold climbing simultaneously because investors hedge their equity bets with a hard asset that benefits from currency debasement. Interestingly, gold and stocks don't always move together. During periods of high inflation or geopolitical stress, gold can rally while stocks drop. But in a typical risk-on environment driven by central bank easing, you see gold and stocks both rising as the dollar weakens. The key is to watch the dollar as the pivot for both. Now, connect the entire chain across markets. If gold is rising sharply, it often precedes or accompanies a weaker dollar, which then supports oil prices, which lifts the Canadian dollar. Simultaneously, a weaker dollar tends to support emerging market assets that are priced in dollars, making their debt more manageable. Meanwhile, stocks in the US might either rise from the liquidity boost or fall if rising oil costs start to hurt consumer spending. The practical takeaway for any trader is to never look at a single market in isolation. When you see a strong move in stocks, immediately ask what it means for the dollar, then oil, then gold, then the commodity currencies like CAD, AUD, and NZD. You can also use this as a confirmation tool. If stocks are up but the dollar is also rising, that's a mixed signal that might be driven by flight to safety rather than pure growth optimism. Conversely, if stocks, oil, and gold are all up while the dollar slides, the trend is cohesive and more reliable. Mastering intermarket analysis means treating the markets as a single evolving ecosystem. Every move in one asset sends ripples through the others. By mapping these connections, you can spot divergences that signal reversals before they appear on any single chart. Start with the core pairs: equities versus dollar, oil versus CAD, gold versus dollar. Once those make sense, expand into bonds, base metals, and emerging market currencies. The reward is a broader, more robust view of where capital is flowing and why.